On July 8, 2026, Apple Incorporated filed a Form 8K with the Securities and Exchange Commission announcing the relocation of its primary operational headquarters and approximately 12,000 senior corporate engineering and operations positions from its Apple Park campus in Cupertino, California, to a newly expanded campus in Austin, Texas. 49 years of continuous corporate presence in Santa Clara County gone, and the state of California just lost the operational center of gravity of the most valuable publicly traded company in the history of human commerce, along with approximately $391 billion in associated annual revenue activity that had been administered, decided, and accounted for inside its borders for nearly half a century. Now, I have watched a lot of companies move in my 95 years on this earth. I have watched giants open in places nobody believed could attract them and consolidate in places everyone assumed were permanent. I have watched the most rooted technology companies on this continent quietly reassess where they wanted to be 10 years from now and act on the answer. But what just happened between Apple and the state of California is something I want to walk you through carefully. Because this is not a story about a technology company moving 12,000 employees from one campus to another. This is a story about a state that watched its operating environment for global corporations erode for a decade, listened to its own governor describe the erosion on a public stage, and is now staring at the partial vacancy of one of the most architecturally significant corporate campuses ever built, wondering how the original arithmetic ever worked. And the people paying for that partial vacancy are not Apple shareholders. They are the workers who showed up to Apple Park every morning and the working families across the Bay Area who never had the option to leave. I have been sitting in the same office in Omaha, Nebraska for over 50 years. Same desk, same chair, same view of a parking lot that has not changed in any meaningful way since the Ford administration. I drink about 5 cherry Cokes a day, which is to say, I am perhaps not the most fluent commentator on the latest features of an iPhone, but I have owned shares in this company for a long time, and I have studied it closely. I still live in the house I bought in 1958 for $31,500, and every single morning I show up to that office because there is nothing on this earth I would rather be doing. People ask me all the time why I never moved Berkshire Hathaway to California or New York or anywhere else with more glamour. And I always give them the same answer, because the business I was building did not care what zip code I was sitting in. The numbers worked in Omaha, so I stayed in Omaha. Apple operated its corporate headquarters in Cupertino for 49 years for exactly the same reason. The numbers worked, and then they stopped working. And the moment they stopped, the company did what any rational corporation does when the arithmetic changes. It followed the math. Now, let me tell you how a company founded in a Los Altos garage in 1976 became the most valuable enterprise in the history of publicly traded equity. Apple did not become Apple by staying in the garage. It became Apple by building, decade after decade, the products that defined how human beings interact with information. The company opened its first dedicated Cupertino offices in 1977, expanded across the Santa Clara Valley through the 1990s and 2000s, and in 2017 occupied Apple Park, the 175-acre campus that became one of the architectural symbols of American corporate ambition. By 2026, the firm employed approximately 38,000 people in California, generated, according to its annual filings, approximately $391 billion in global revenue, paid an estimated $8.4 billion annually into the California state and local tax base across corporate, payroll, sales, and property tax categories, and supported by the most credible regional economic analyses, somewhere between 90,000 and 110,000 additional jobs across the Bay Area through supplier contracts, professional services, construction, and the gravitational pull on adjacent technology firms. Apple was not just a tenant in California. It was the single most consequential corporate presence in the state's modern history. And California had 49 years to understand exactly what that presence represented. Now, I want you to pay close attention to what happened next, because this is where my partner Charlie Munger's most important lesson becomes impossible to ignore. Charlie used to say, "Show me the incentive, and I will show you the outcome." Always the incentives, not the intentions, not the press releases, not the speeches at industry conferences, the incentives. So let us look honestly at the incentive structure California built for its largest corporate employer over the last decade. And let me be clear at the outset, the people who built this structure were not bad people. They were responding to genuine concerns, a housing affordability crisis affecting millions of working families, an income inequality gap that had become socially destabilizing, a public infrastructure system that needed investment, and climate obligations that no responsible state government could ignore. I understand every one of those concerns. They were real. But over a period stretching from roughly 2017 through 2026, California assembled a stack of conditions that, taken individually, each had a defensible rationale, and taken together produced a mathematical conclusion the legislature never quite stopped to calculate. There was the 2012 Proposition 30 income tax increase, extended by Proposition 55, raising the top marginal personal income tax rate to 13.3%, the highest in the country. There was the 2024 expansion of that top rate through the additional 1.1% payroll surcharge for state disability insurance with no wage ceiling, pushing the effective top marginal rate on senior technology compensation above 14%. There was Assembly Bill 5 and its restructuring of the contractor classification rules, which materially affected the cost structure of every major technology firm in the state. There was the steady rise in commercial property assessments on Class A research and development campuses. There was Senate Bill 253, the climate disclosure mandate, with compliance costs phasing in through 2026. There was the cumulative effect of California's franchise tax on globally operating corporations, with apportionment formulas tilted heavily toward sales destination. And then, in the early spring of 2026, came the fatal detail. The California Franchise Tax Board issued a revised technical advice memorandum reinterpreting the sourcing rules for intangible licensing revenue generated by California-headquartered technology companies, with the practical effect of raising the effective California tax exposure on Apple's intellectual property licensing income by an estimated $1.7 billion annually, beginning with the 2027 tax year. Now, I want you to read that number the way the Apple Board of Directors read it in the spring of 2026. If you are sitting in Cupertino with a team of advisors, and Apple Incorporated has approximately the most sophisticated team of advisors in corporate America, you are looking at $1.7 billion in additional annualized California tax exposure on a regulatory reinterpretation you do not control in a state where your operating cost structure for senior technology talent was already running materially higher than your costs in Texas, where the top marginal personal income tax rate is zero, where there is no franchise tax on intangible licensing revenue, and where the company had already invested heavily in an Austin campus that was operational and expanding. You compare that figure to the cost of consolidating senior corporate engineering and operations functions into the existing Austin footprint, where the company had been building for the better part of a decade and where the supporting infrastructure was already in place. The math is not close. It is not even an interesting question. The window to act is not after the 2027 tax year begins. The window is now, while the relocation can be staged on the company's preferred timeline rather than executed under fiscal pressure. Clear incentives produce predictable behavior every single time. What followed was not a single corporate decision made in isolation. It was a bank run. I want you to hold that image because it is exactly right. When depositors believe a bank is about to fail, they do not wait politely for official confirmation. The ones who move first lose nothing. The ones who wait lose everything. So everyone moves first. That is the structure of what has been happening to California's senior technology employer base for the better part of a decade. The largest corporate employers in the state have been making the same simultaneous rational calculation Apple just finalized, and they have been quietly relocating headquarters, shifting senior leadership, and reallocating capital before the next regulatory window closes. And the Apple announcement, when it came on July 8th, did not arrive alone. Tesla moved its corporate headquarters from Palo Alto to Austin in 2021. Oracle, founded by Larry Ellison, relocated to Austin in the same year. Hewlett-Packard Enterprise, the direct corporate descendant of the company that arguably founded Silicon Valley, relocated to Spring, Texas. Chevron moved its corporate headquarters from San Ramon to Houston in 2024 after a century in California. Charles Schwab, founded in San Francisco, moved its headquarters to Westlake, Texas. McKesson, the largest healthcare company in California by revenue, moved to Irving. Jacobs Engineering, headquartered in Pasadena for decades, moved to Dallas. Palantir, founded in Palo Alto, relocated to Denver in 2020. And now the most valuable publicly traded company in the world, after 49 years of continuous Cupertino presence, has filed its 8K to consolidate its primary operational headquarters into Austin. And in my experience, the names you can confirm publicly in any corporate migration are rarely the complete list. The estimated aggregate loss to California's industrial and technology tax base from confirmed major headquarters relocations alone since 2020 exceeds $4.2 billion in annual state revenue, and that figure does not yet incorporate the Apple consolidation. I want you to sit with that number for a moment, $4.2 billion. That single figure, the annual loss from confirmed corporate departures before Apple's was filed, exceeds the entire annual operating budget of the California Department of Forestry and Fire Protection in a state where wildfire response is one of the defining public obligations of the government. Now, I am going to tell you about the moment in this story that I find the most extraordinary, the moment that, to my mind, defines this entire situation better than any 8K filing or relocation announcement possibly could. June 3rd, 2026. The Bay Area Council is hosting its annual economic summit at the Moscone Center in San Francisco. Governor Gavin Newsom takes the stage for a moderated conversation with the council's chief executive. It is 35 days before Apple's 8K is officially filed with the SEC, 35 days. And standing in front of an audience of senior partners from every major technology, venture capital, and professional services firm in Northern California, in a venue specifically designed to project the state's continued centrality to the global technology economy, the governor of California says, in his own words from the published transcript, that California must, and I am quoting, take seriously the fact that our largest corporate employers are being courted aggressively by states that have structured their tax codes specifically to acquire them, and that the legislature, again quoting directly, cannot continue to assume that the presence of our most rooted companies is permanent simply because it has been continuous. The sitting governor of California on a public stage at the Moscone Center 35 days before the largest single corporate consolidation in the state's modern history was officially filed, describing with measured accuracy the precise mechanism of deterioration that was already executing in a boardroom in Cupertino while he stood there and spoke. I have been in business a long time. I have sat across the table from a lot of extraordinarily capable people, and I will tell you honestly, I cannot think of a parallel. A chief executive publicly describing the failure conditions of his own administration's regulatory framework while the failure was already in motion, while he was simultaneously continuing to sign and defend the very provisions that made it inevitable. That is not contradiction. That is a governing situation so thoroughly documented in real time that it almost defies analysis. Now step away from the executives in Cupertino entirely for a moment. My father, Howard Buffett, was a congressman from Nebraska and a deeply principled man who taught me that the measure of any economic policy is never what it promises on the day it is announced. It is what it delivers to ordinary people living inside it 10 years later. So let me tell you about Diana Whitfield. Diana is 49 years old and has worked for Apple for 17 years, the last 9 of them as a senior operations program manager in the supply chain organization at Apple Park. She makes a base salary of $214,000 a year with additional restricted stock compensation and supports a household of 4 in a 3-bedroom house in Sunnyvale that she and her husband bought in 2013 for $1.1 million. Her husband is a 5th grade teacher in the Cupertino Union School District, where he has accumulated 21 years of pension service. Her older son is a sophomore at UC Davis. Her younger daughter is in her second year at Homestead High School, the same school where Steve Jobs himself once attended. The July announcement gives Diana and her colleagues the option to relocate to Austin at company expense or accept a continuation of her California role, with the understanding that future career progression within the operations function will be substantially concentrated in Texas. Diana cannot move her family to Austin. Her husband's California teacher pension does not transfer. Her daughter's high school continuity does not transfer. Her elderly mother in Mountain View does not transfer. The $391 billion in annual revenue that Apple administers and the 38,000 California jobs it currently supports were not abstractions to Diana. They were the basis on which she and her husband built the last decade of their lives. She did nothing to cause this. She had no seat at the table when the Franchise Tax Board issued its technical advice memorandum. And the gap that the relocation of 12,000 senior positions opens up does not quietly disappear when those positions move. It works its way through people like Diana quietly, one career decision at a time. In my experience, damage of this kind moves in distinct layers. One company consolidates its headquarters. The corporate parent reallocates the capital that would have funded California campus expansion, supplier development, and local research partnerships toward the new operational center. The cities of Cupertino, Sunnyvale, and Santa Clara lose, by the projection of the Bay Area Council Economic Institute, approximately $312 million in annual direct sales tax, payroll tax, and property tax revenue from the relocated operations and their associated spending, plus an estimated additional $187 million in indirect business tax receipts from the supplier firms, the legal and accounting providers, the construction contractors, and the food service operations that orbited the Apple presence. The commercial real estate market in the affected corridors absorbs a measurable increase in vacancy on Class A research and development space. The Cupertino Union School District, which receives a meaningful portion of its facilities funding through local property tax flows, begins quietly modeling reductions in its capital budget for the 2028 academic year. The local Second Harvest Food Bank and the De Anza College Foundation, both of which counted Apple as a major corporate donor, are now adjusting their development projections. That is 3 full levels of damage from a single corporate consolidation. Multiply that structure across the 9 confirmed major headquarters relocations out of California since 2020, and you begin to understand the actual magnitude of what has happened to the state's senior employer base. And California is not running this experiment alone. That is the part I need you to hear clearly. New York lost a steady stream of financial firms to Florida and Texas through 2024 and 2025, with the Florida Department of Economic Opportunity reporting approximately $341 billion in cumulative financial firm assets relocated from New York to Florida since 2020. Illinois watched Boeing, Caterpillar, Citadel, and most recently J.P. Morgan Chase relocate or consolidate operations out of Chicago, with aggregate annual revenue losses to the state exceeding $1.8 billion. Minnesota's corporate income tax structure has triggered quiet conversations among at least 4 Fortune 500 headquarters currently based in the Twin Cities. Connecticut watched General Electric leave Fairfield for Boston in 2016 and has spent the subsequent decade attempting to rebuild its corporate tax base. The same template, the same incentive structure, the same mathematically predictable outcome running on a slightly delayed timeline in each state. This is not 5 separate state-level stories. This is one national story about what happens when the incentive to leave becomes structurally more powerful than the incentive to stay. I have made a lot of investments over the course of 70 years of reading financial statements, and the single most important lesson I have learned across all of it is this: you cannot earn your way out of a structural mistake by hoping that the people most affected by it will not notice what you have done. They notice. They always notice. And when they have the means and the mobility to act on what they notice, they act. Without exception, without sentiment, without waiting for permission. California is now attempting to figure out how to retain a senior corporate base that has been quietly drafting its exit plans for the better part of a decade. The company that opened its first Cupertino office in 1977 is consolidating its primary operational headquarters into a campus 1,750 miles east of Apple Park. Diana Whitfield is making the most difficult career decision of her professional life. The Bay Area Council Economic Institute is modeling Santa Clara County's 2028 budget around a property tax base that just lost its most consequential anchor. And the governor, who described the precise mechanism of this departure on a stage at the Moscone Center 35 days before the 8K was filed, is preparing his next budget address. I stayed in Omaha my entire life because Omaha never gave me a reason to leave. That is the only reason any person or any business stays anywhere. Not loyalty, not habit, not the sentimental memory of a garage in Los Altos in 1976. The math. Change the math, and you change the behavior every single time, without a single exception in the history of commerce. The money never sits still when you announce publicly where you intend to send it. And capital never stays in a place that has stopped making the arithmetic work, even when the capital belongs to the most valuable company on earth, and the place in question gave that company the room to grow into what it became. If you are watching this from a state where these conversations are just beginning, where the legislature is debating its own intangible licensing reinterpretation or its own top marginal rate adjustment or its own franchise tax restructuring, you are not watching California's problem from a safe distance. You are watching your own situation playing out one election cycle ahead of you. If you have seen corporate campuses quietly thin out in your county, neighbors stop talking about promotions they used to mention, or job postings simply stop appearing the way they once did, leave a comment below. Tell us what state you are in, what industry you work in, what you are actually seeing on the ground. Subscribe to this channel because this story is nowhere near finished. The numbers are still moving, and wherever the numbers go, the story follows. They always do.